There has never been a greater time than now to invest in the Metro Detroit area, and there is no other investment firm better qualified than Platinum Real Estate Holdings. With 40 years experience and over 1,000 homes sold, let Platinum Real Estate Holdings assist you with the purchase of a city-certified home of the highest quality, turnkey properties, screen renters, yielding instant cash flow. Well, what are you waiting for? Call or visit us online today. Welcome to the weekly recap for the week of February 20th. In today's recap, we're going to talk about creative financing, 5 outside-the-box tools savvy investors use to build wealth, and lastly, 4 ways to survive future real estate crashes. This week's recap begins now. 5 outside-the-box creative financing tools savvy investors use to build wealth, from BiggerPockets.com contributor Chad Carlson. In this report, Chad will share 5 of his favorite creative financing tools, aka power tools, to help you build more wealth and create more passive income for yourself. Let's talk about a picture of a traditional financed real estate closing. There are 4 primary entities involved. Number 1, the seller. Number 2, the buyer. Number 3, the bank lender. And number 4, the closing agent, which is an attorney or title company. The closing attorney or title company uses pre-closing agreements to oversee the closing transaction to ensure the other 3 parties are treated fairly per the terms of their contracts. The items actually exchanged between the parties include, number 1, the money from the bank to the buyer, which is the loan. Number 2, the contracts, promissory note, and a mortgage from the buyer to the bank. Number 3, a deed from the seller to the buyer. And number 4, the money from the buyer to the seller. For those of you already investing, this may seem basic, but it's important to start here before doing transactions that are a little more creative, because these creative tools use the same basic format. Now, let's unpack Chad's 5 favorite creative financing power tools from his toolbox. Power tool number 1 is called seller financing. The main difference between a seller financing transaction and a transaction with a bank loan is no bank. In fact, technically, there is not even a loan. The seller never gives the buyer any money like a bank would. Instead, the seller just agreed to let the buyer pay the purchase price over time with monthly installments. In exchange for this financing arrangement, the seller, not the bank, receives the promissory note and mortgage as security. The beauty of this arrangement is that there are only 2 parties, the buyer and the seller. The seller does not have loan committees, underwriters, or your Fannie Mae conforming rules. You make an offer to the seller, the 2 of you negotiate, and if it makes sense for both parties, you move forward. Power tool number 2, private loan from a self-directed IRA. The difference here is that the lender is a self-directed IRA, or individual retirement account, and not a bank. Most retirement accounts invest in traditional assets like mutual funds or bonds. But a self-directed IRA is a way to use retirement savings to invest in alternative assets like real estate, notes, tax liens, and more. Specialized custodians who allow self-direction hold the assets and process transactions and keep records for the IRS. The point of this tool is to borrow the IRA funds from other individuals, not your own IRA. You must be very careful not to engage in IRS prohibited transactions. Loaning money to yourself or to your business is clearly off limits. Some of the best candidates who may have the funds available are other real estate investors who can't loan that money to themselves. Power tool number 3, private loans outside of an IRA. The only difference between power tool number 2 and power tool number 3 is that the private lender uses funds outside of an IRA. The most likely candidate is an individual with a large network. You can find these individuals at real estate networking events like BiggerPockets meetups or your local real estate club. Attend these events and get to know people. Once you get to know people, they may be willing to loan you money. A fantastic power tool is number 4, master lease with option to buy. Chad asked you to imagine offering a burned out real estate owner of a quadruplex building a 5-year lease for the same amount she currently receives in rent from tenants. You also offer to perform immediate cosmetic repairs like painting and carpeting. The owner will continue to pay for taxes and insurance and handle any major capital expenses such as roof, heat, and air conditioning systems and structural issues. And you will be responsible for all vacancy costs, turnover costs, maintenance costs, etc. Let's say after vacancy and maintenance expenses, you receive positive cash flow of $600 per month. That's $36,000 over 5 years. Stacking up a few deals like this could be very lucrative. However, what if the burned out quadruplex landlord is willing to give you an option to buy the property as well? You will have multiple exit strategies at your disposal with options. A well-crafted option gives you at least 3 profitable exit strategies. The first exit strategy for you is to patiently save a down payment and look for permanent financing and/or partners. The second is that you could use this as the replacement property in what is called a 1031 exchange. This would allow you to sell another rental property you own, exchange into this property, and defer your taxes on the gain of the sale. Given that many investors don't have the perfect property picked out when they execute a 1031 exchange, this can be a big benefit. And finally, the third, you could sell your option to another investor. Say your strike price is $120,000. You sell to another investor for $160,000 and you make a profit of $40,000. Even if things go badly with the lease option, you only risk your initial investment, time and energy, and any potential negative cash flow during the 5 years of your lease. After that, you can legally just walk away. Try that with the bank. And finally, power tool number 5, master lease plus option with a credit partner. If you like master leases and options with sellers, the next tool will give you a different way to use the same technique. Instead of a lease option in the property from a seller, you lease option it from a credit partner. Let me explain. Let's say an entrepreneur named Carla finds a great rental property deal worth $150,000 that can be bought for $100,000. The only problem is that she doesn't have the money to close. She knows a private lender named Jim with $20,000 cash, but obviously that's not enough. After further questioning, Carla learns that Jim does have excellent credit and can get a mortgage. So the two of them agreed to the following. Number 1, Carla, the entrepreneur, signs the purchase contract to Jim, the credit partner. Number 2, Jim applied for a traditional bank loan and purchases the property for $100,000. Number 3, Carla immediately master leases the property for 5 years at $525 per month to Jim, net rent. She pays all the expenses. Number 4, Carla also retains an option to repurchase at a higher price of $110,000. Number 5, Carla manages the rental until future exit strategies are available. Carla then proceeds to rent to a subtenant for $1,200 per month. Her net income looks something like this. She gets the $1,200 minus $500 operating expenses, $525 in rent, where she receives a net income of $175 per month. While $175 seems like a nice cash flow, Carla will be wise to set aside a good portion of her cash in reserve for capital expenses and vacancies. Meanwhile, Jim uses the $525 in rent from Carla to pay his $425 mortgage payment, and he still has $100 left over to put in his pocket. What tools are in your toolbox? The point of this article is to ask yourself, can you use any of these tools to build wealth and income? Decide on 1 or 2 of these tools that you'd like to add to your toolbox. Then commit to master that tool. Learn about it, practice it, ask questions. Then as quickly as possible, start using the tool in your real estate investing. For more in-depth information, complete with diagrams, search for Chad Carlson's 5 outside-the-box creative financing tools at biggerpockets.com. Next up, 4 ways to survive future real estate market crashes. The real estate market may be very healthy compared to what it was 5 years ago, but that doesn't mean we're in some sort of eternal bliss. There will be rough patches ahead, and likely a couple more crashes in our lifetime. But how can you, as an investor, safeguard yourself against them? Historically, economic activity rises and falls in marked business cycles. Senior market strategist Susan Green explains. Periods of recession appear and recede approximately every 5 to 10 years. Here are 4 ways to protect yourself. Number 1, buy properties that rent below the median. You have to think one step ahead of the market. While it's a good rule of thumb to have the best property on the street, you don't want to be stuck charging a rent that's higher than the median in the area. This may be fine during times when the market is healthy, but you'll get swallowed up when the market falters. Number 2, be the best landlord possible. It pays to be a good person. When you're a likable landlord who works with people, deals with maintenance issues in a swift manner, and charges affordable rent, people are more likely to stick with you when the market turns. Number 3, be realistic with cash flow numbers. When purchasing a new property, be conservative and honest with your numbers. Open a spreadsheet and factor in all expenses. What is insurance going to cost? Is there an HOA fee on the house? Are you getting a home warranty? You want to know down to the penny what your cash flow will be on a property. And finally, number 4, pay down mortgages when possible. There's always the question of whether it makes more sense to pay down an existing mortgage or put that money into a new piece of real estate. While there are schools of thought that apply to both, consider paying down rental property mortgages when you can. This gives you some leverage if the market crashes and you have difficulty making payments. Never put all your eggs in one basket. Financial diversification is your friend. Real estate may be one of the more stable and appreciation-friendly investments you can make, but don't put everything you have into real estate. Spread yourself out a bit and diversify as much as possible. This mitigates your risk and provides you more tolerance in a down market. Well, that's this week's recap. Did you find this recap helpful? Let us know in the comments below. Thank you for listening and have a great day. This has been your weekly real estate investment news recap. Did you find this recap helpful? Please like or comment below this video to enter to win a free copy of our ebook, The Ultimate Real Estate Guide for Residential Real Estate Investments. You can also subscribe to our channel or go to our website to receive the latest in real estate news. Our website also affords you the opportunity to view our latest turnkey properties.